we discussed, certain investments are reported differently under statutory accounting principles and generally accepted accounting principles. Statutory, we use stat in the workplace, and GAAP is a common abbreviation for generally accepted accounting principles. To highlight some of the differences between statutory and GAAP, we're going to discuss how investments are treated differently in each. For cash and cash equivalents, generally, it's the same between statutory and GAAP, except for one additional classification or type of investment is included in cash and cash equivalents under statutory. Statutory cash and cash equivalents also include savings accounts and certificates of deposits in banks with maturity dates within 1 year or less from the acquisition date. Whereas within GAAP, usually it's just if you have an original maturity of 3 months or less. For bonds, traditionally under GAAP, they can either be classified as trading or available for sale or held to maturity. Trading and available for sale are recognized at fair value, while classified while held to maturity are classified as amortized costs. Under statutory, bonds are rated by the National Association of Insurance Commissioners, or NAIC, and depending on that rating, 1 through 6, it changes how the investment is reported. NAIC designations of 1 through 5 will be reported at amortized cost, while all other debt securities at NAIC designation 6 will be reported at the lower of amortized costs or fair value. Common stock, usually under GAAP, you report it at fair value, which is easily obtained from a published source such as, the stock exchange. Under statutory accounting, investments in unaffiliated common stock are generally reported at fair value, as stated by the NAIC's Investment Analysis Office, which is the SVO. As far as unrealized gains are concerned, unrealized gains under statutory or losses under statutory accounting are recorded directly to surplus for any investments that are held at other than amortized cost. Under GAAP, unrealized gains and losses are recorded in net income for trading or other comprehensive income for available for sale. In the future, we're in that future, equity investments will be measured at fair value with all changes in fair value recognized in net income. One other unique aspect of investment or insurance investment accounting and insurance accounting in general is the presence of admitted and non-admitted assets. Under statutory accounting, certain assets are excluded from the statutory balance sheet and directly reduce their surplus. Major non-admitted assets include agent balances, uncollected premiums over 3 months due, certain amounts of deferred tax assets, certain intangible assets in furniture, fixtures, and equipment. And we'll get into why these non-admitted assets are excluded from the statutory balance sheet. And as we know in GAAP, there's no such thing as a non-admitted asset.